In this video, we're going to break down the 4 non-conventional ways that you can still buy real estate. So most loans are in this conventional bucket, the Fannie Mae, Freddie Mac, FHA loans, which are great for buying property, but they have a max to them. And not many people realize you can only have 10 conventional loans at any time. So when we're really starting to build a real estate portfolio, a lot of the experienced investors I work with are going to do more loans in this non-conventional space. What is a non-conventional loan? It simply means that it's not a government-backed program. There are a ton of private lenders, other big, large national companies that do non-conventional loans as well, or groups of people that have a REIT or other ways that they're willing to invest in people's real estate endeavors that aren't necessarily the conventional bucket. The most common misconception with non-conventional loans is that they're scarier or more risky. Most time, non-conventional loans require you to have a higher FICO score, and in fact, the foreclosure rate or the rate that these loans go bankrupt or are misused is much lower than conventional financing because we're dealing with more experienced real estate investors. There are a ton of non-conventional loan products out there and ways to get other people's money to invest in real estate, but here are the 4 top most popular non-conventional loans. Number 1, bank statement income loans. Bank statement income loans are for self-employed borrowers. So you have to have your own business, your own LLC, S Corp, in order to utilize this product. The good news is it's extremely easy to have an LLC. I always encourage people to try to pay Uncle Sam as least as possible. So if you are self-employed, but you've written off all of your income, and now you're really struggling to get approved to buy property, come talk to me. There's so many different ways to do it, and one of the best ones is bank statement income. We're looking at either 12 months or 24 months of bank statement history. This could be personal bank statements, business bank statements, or even a mixture of both. When we're looking at all of your bank statements over that 12-month period, let's say, then we're looking at just the deposits coming into that bank. So any amount of revenue your business is generating is being deposited into this one main account, and we're just looking at how much you averagely get deposited into that account over that 12-month period. So say you have a bunch of random different deposits, but over 12 months, that averages out to be about $10,000 a month, each month in deposits. Well, you might say there's a ton of expenses coming out of that account as well. I don't have $120,000 just sitting in this account. That's okay, because we're not looking at the expenses being drawn out. We're just looking at the deposits. All bank statement income loans will have to include a expense ratio. Most expense ratios are going to start at 50%. So they're going to take that $10,000 of income you make each month on your deposits and cut it in half and say we can qualify you for $5,000 a month. There are ways that you can reduce that business expense ratio to be less than 50%. So if you get 40%, 30%, 20%, that's a great way to get more qualifiable income. Different ways to go about this would be CPA letters or ways that we can prove that you don't have brick and mortar office buildings or a staff if you're a real estate agent, or if you're somebody that is just an independent contractor working by themselves, then obviously you have probably less than 50% expenses that go into your business. So there's ways to prove that we'll need to show the underwriters to get you approved for that loan, to get your expense reduced and get you qualified for more income. The number one benefit of a bank statement income loan is we're not looking at your traditional debt to income ratio anymore. We're looking at the income we can prove off of just your bank statements alone and ignoring your tax returns. There's a myriad of different ways that you can do bank statement income, so it's extremely important to talk to a professional, talk to a licensed loan officer like myself to get an exact calculation of what your bank statement income is compared to your debts and how much you can get approved for. Most times I find with self-employed borrowers, if we're looking at tax returns that they've happened to write off some of their income on, they might be approved and capped out at $100,000 loan. When we do a bank statement income loan, that might get up to $500,000, $600,000, and it's a vast difference between the two. It's important to remember what you can get qualified for as a bank statement income loan is not always the wisest decision for you to use that max amount. So please talk to me about how to be safe about your money and not get into a heap of trouble by taking out more than you can actually afford to do. Number two on the most popular non-conventional loans would be asset utilization. Asset utilization is an amazing tool for a lot of different people. We're not looking at any employment history or income from an employer or traditional income in that sense. We're going to calculate the amount of income we can approve you for based on how many assets are in a certain holding, whether that's stocks, bonds, 401k, IRA, in a checking account. It doesn't matter. There's different ratios that can be counted based off of those. So again, it's important to talk to a licensed professional that knows what they're doing to get that exact calculation. But the main point with asset utilization is that this is great for people that maybe just sold a business or they've been working in an industry for a while and saved up a bunch of money in their 401k, but then they decided to leave that industry and they don't have a repeatable 2 year history of W 2 employment anymore. Or think about grandpa or grandma that maybe want to help co-sign on a property with you, but they don't have a job anymore. So they don't have income traditionally, but they might have a lot of savings. We can take those savings and do a calculation based on those to get them qualified for an income, to get you qualified for a house and buy property. Number three on the list, we have hard money loans, or what often is used for fix and flip projects. The main purpose why people use fix and flip loans or hard money loans is that you not only get money for the purchase of the house itself, but you also get money for the rehab and the cost of repairs. This can be a huge difference when looking to buy a house conventionally and move into it and fix it compared to buying a house and getting a loan based off of the cost instead of the value. So the loan to cost or the ARV, after repaired value, are things that we're going to look at as a hard money or fix and flip loan instead of just the value of the house and basing your loan off of the percentage of the current value. So when we're talking hard money loans, the main downside of a hard money loan is the very high rates in which they come at. Where a conventional loan on a house might be in today's value anywhere around 6, 7%. A conventional investment loan might be a little bit more than that, 7, 8%. A hard money loan is going to be 12, 14% sometimes. So it is more of a short term loan to where it's meant to get into a house, fix it up, and then refinance out of that or sell the house to pay off that loan. If you're a fix and flip investor, the entire point is to find an undervalued property that needs some fixes and some love to make it at a higher value in which you can turn around and sell it or move in tenants and start renting it out. But either way, you're looking to get out of that first hard money loan as quickly as possible. Yes, the 12% rate might cause for extremely high monthly mortgage payments, but most fix and flip investors are looking at that just as a holding cost. A holding cost is looked at as the expense that you are taking on each month that it takes you to complete that project. So most investors are looking to complete that fix and flip within 3 to 6 months. Some can go faster if you're experienced, some might take longer if you run into issues that are unexpected. Just like investing in stocks, the more risk there is, the higher the chance of reward. And fix and flip is definitely a high risk, high reward scenario. When you go into this property, you don't know what's going to be behind the walls. And you don't know what is going to happen during this renovation. And this high percentage hard money loan that you get to do so could start accruing more and more and more costs the longer you have to hold this property. So say you're thinking that this renovation is going to take 3 months, and at a 12% rate on a $300,000 home, for random purposes' sake, let's say your mortgage is $4,000 a month, compared to a conventional loan might be $3,000 a month. So that's an extra $1,000 a month holding cost every month you hold on to that property. That can add up over time very quickly, and it's important to know your exit strategy before going into any hard money loan. There are a ton of different hard money loans out there that come in a lot of different varieties. So it's extremely important that you talk to somebody that is a licensed professional or in this world constantly, like myself, to talk about the specific pros and cons to the hard money loan that you're personally looking to do. The fourth and final non-conventional product I want to talk about is probably the biggest buzzword in real estate investing. That's DSCR loans. What is a DSCR loan? It stands for debt service coverage ratio. So if the debt of that property is covered by the service that that property is doing, so the rent that it takes, then that is the ratio we use. So say $3,000 is your mortgage and you get $3,000 of rent. That is a 1.0 even DSCR ratio. Any more rent than you get than the cost of the mortgage, you're cash flowing positively, is a 1.1, 1.2 DSCR ratio. If you're not cash flowing exactly, if the debt is more than the rent, you can still be qualified for a DSCR ratio. It's just looked at as a 0.9, 0.8. And depending on where that DSCR ratio lies, it comes with different terms and down payment amounts and rates. So obviously, the more cash flowing, the higher your DSCR ratio, the better terms and rates you're going to get. The lower your DSCR ratio, the worse the terms, the worse the rate. But the key is it's still possible to do. Real estate investors that I work with use DSCR loans all the time. The reason why we're going from this conventional mortgage world into this non-conventional world is usually because we don't want to look at you personally anymore as far as your employment or your income or your tax returns. Oftentimes, we have built and grown our rental portfolios to where it's going to get way more complicated to do a conventional route. And so I personally don't qualify for a conventional mortgage. So then I would need to look at a non-conventional mortgage like a DSCR loan if I'm looking to continue to buy rental properties. A huge advantage of a DSCR loan is how quickly they can be done. Because we're not looking through all of your tax return documents or your personal portfolio, we're just looking at the house itself. We just need an appraiser to go in there and tell us what the house is worth and what the market is going to assume it rents at. And then we know how much the loan is going to be, and we just compare that ratio. We take that information, and the only thing we're taking from you personally is your credit score, and we're qualifying you for that house. So they can close as in as little as 2 weeks. Much like a cash buyer goes and buys properties, you can now compete with all those cash buyers out there with a DSCR loan because it can happen just as quickly. Of course, with any of these non-conventional products, we're going to need more down payment than a 3.5, 5% conventional loan that we're moving into the house as a primary. Usually most all of these we're not moving into as a primary residence. So we're putting at least 20% down, maybe 25% down. Of course, there's a wide range of other non-conventional loans out there, and we're just scratching the surface. So if you want to learn more about what non-conventional loans are out there, and you're sick of doing the conventional route of real estate investing, talk to me. Thank you for following. Thank you for watching thus far. Please make sure to hit the subscribe button if you are interested in other unique, creative ways to grow your wealth through real estate.